Hey guys, today I'm going to be talking about a very special company. This company has been delivering special things to children all around the world for about 96 years. Of course, I'm talking about the Walt Disney Company. This is a company that owns major brands like Marvel, Star Wars, and of course, all of your favorite Disney movies. And in this video, I'm going to be giving you a full analysis about this stock and if it's potentially a good buy for you. But first, let me introduce myself. My name is Zino Rovato, and I am dedicated in helping building your path to financial success. I do in-depth analysis about stocks so that you get all the knowledge and information that you need to make the proper decisions for yourself. So if you want to learn more about that type of content, subscribe to this channel and smash that like button to help me grow this channel. So let's dive right into it. What does Disney do? Disney provides a wide range of different services. Starting with movies, everybody has their own favorite movies. Mine from Disney was The Lion King. But they own much more than just Disney movies. They own a lot of franchises. And they own a lot more franchises than just Disney movies. They also own Lucas movies with Star Wars, ESPN, Marvel, History Channel, National Geographic, and the list goes on and on and on and on. They even own DraftKings. Yeah, and even Walt Disney is in the gambling business. But the thing they know best is how to make content. Content of all different types. And that's what they do best. And what they also have is 6 world famous locations. One of them is in California, the other one is in Orlando, one is in Paris, one is in Shanghai, one is in Tokyo, and the other one is in Hong Kong. Whereas the Shanghai one is the newest one that opened up in 2016. And lastly, what they do is they have their direct-to-consumer channels. These are famous streaming apps like Disney Plus, but they also have other products. For example, ESPN Plus is a new channel that they launched, and Hulu is something that they have acquired for quite some time. And here they show their movies and shows directly to the consumer to increase their profits. Their business models for Disney Plus and ESPN is through subscription model basis, but the one with Hulu is actually one that they use a subscription basis and an advertising model at the same time. And these are all major channels of growth for this company because that is where they have a huge amount of scalability. And I'll talk more about that later on in this video, exactly how that's going to emphasize their growth. Now let's analyze all parts of their stocks. And I do this in 4 main key points. One, I'm going to be talking about their current value. The second is I'm going to be talking about their growth. The third is I'm going to be talking about the risk that the company has at this moment. And the fourth is I'm going to be talking about their management. And combining these 4, I'm going to give them an overall score, which we're going to use to evaluate if this company is good or bad. But first, if you like this content so far and you think this is interesting, consider subscribing to this channel and smashing that like button to help me grow this channel even further. By smashing that like button, you really help me out, and I really appreciate it if you did it. So let's talk about their current value. And right now, their valuation has been hit hard because of the current crisis. Because what has been happening to Disney right now is actually that because of the current situation, they had to close down all of their parks. And because they closed down all of their parks, they didn't get any revenues from this as well. But that was not the only thing that happened to Disney. There was also a situation where they had to postpone the ESPN broadcasting from the NBA, and that has caused them not to generate any advertising revenues from this as well. So overall, they've been hit quite hard on their overall valuation because of the lost revenues that they had with the closures and all the other aspects. But it's not only just the park closures and ESPN. There was also a case where they had to postpone their shows, which basically causes them to lose revenue off of that. One of the biggest cases there is with the movie Mulan. With Mulan, they actually could not show it in movie theaters anymore, and they actually chose to do it directly to the consumer through their Disney Plus app, and that caused them to lose revenue there as well. But one thing that is very good for them and their valuations right now is that their direct consumer side is actually growing quite considerably, which is helping them with their earnings potential. But overall, if I look at this stock at general for their current valuation, I rank them as a D overall. That is basically because they are making a lot of losses right now. Their earnings is not quite on the level that you want to have them, but their direct-to-consumer side is more positive, so it isn't an F, but it is definitely not as good as I would like to have it for evaluation. And that is why I'm ranking it at a D. But one thing that I definitely see that is still very positive for them, even with all of the situations that's going on right now, they still were able to make a profit of 8 cents. Now let's see what Bob Chapek said about their current focus and their growth. Given the rapid changes in consumer behavior, we believe it is more important than ever we continue to grow our direct relationship with our customers. which means basically Disney is all in into their direct-to-consumer channels. Currently, Disney Plus is actually launching in key specific markets, which is the Nordics, Belgium, Luxembourg, Portugal, and Indonesia. They're launching this right before the season 2 of The Mandalorian, which will be a very big impact on their growth of this specific app. And right now, the marketing budgets spent there on Disney Plus are extremely high, which is a very good growth multiplier. Right now, the Disney Plus app is at 60 million subscribers. They achieved this within a year time. This was their 2024 forecast, so they're growing much quicker than expected. And just think about it. Disney right now has the same market valuation as Netflix, but their subscriber growth is growing at an extreme rate. So how is this going to affect their overall market valuation in the future if they're growing at the rate that they're doing right now? That probably is going to be an indicator that they're going to be able to increase their overall market valuation by at least double. But not only has Disney have their Disney Plus app, they're also launching a new subscription service in 2021, which is under the Star brand. And this is a lot of different types of movies, which is also going to be a direct-to-consumer channel. Now, for my own projections right now, if I'm looking at their direct-to-consumer side, they're right now at the total revenue of $10 billion a year. But looking at their potential growth with the current marketing that they're doing, I expect this to grow to at least $55 billion. And that basically means that Disney can actually double their total amount of revenue in a period of only 5 years, which is very, very good. And they're also doing other things for the growth aspects to the direct-to-consumer side, which basically means a premium video on demand service, basically allows them to sell the videos that they're making directly to the consumer without even going to the movie theaters, which is a new model and can basically show a very good positive side to the revenue of every user that they generate. One of the examples that they're doing this on right now is actually with Mulan, which they shifted their focus of not showing it in the movie theaters and actually trying to sell it directly to the consumer for $30. So overall, I rank this stock right now for a growth ranking of at least an A. And because I'm doing this because they have so much different channels that they're growing on and really focusing on, I think their total combined product that they're going to be able to sell in the next 3, 4, 5 years is going to be very profitable. Now let's talk about their risks. Well, the current crisis hit Disney quite hard. They had to close down all of their parks because of the current crisis. But not only that, because of the situations, a lot of the new content that they were creating was postponed and was pushed ahead. And what does this mean for Disney for itself? Well, it's quite simple. If you can't create content, you can't sell it, you don't generate revenues. So because they had to postpone a lot of this content, they basically had to push forward the revenues that they might be able to make from that in the future, which means on the short term, that can have a negative effect on their earnings and their revenue generated from it. But not only that, they also have a situation right now with ESPN. They wanted to show all of the showings in Q3, but they couldn't do that and had to postpone that. And that means that they're not earning any money off of that right now. And they had to postpone the licensing costs of that too, which is now all pushed into the fourth quarter. Meaning this last quarter is going to be higher cost. But at this moment, a lot of advertisers are actually cutting their advertising budgets, which means this can have a downward effect towards their earnings from their ESPN channel. So the major risk here is the limit of profitability in the short term. They're basically not going to be as profitable as they used to be from these specific content sections because they can't make the same amount of profitability from advertising, and also is that the production cost of this new content is also going to be higher. What we're seeing across the board is that a lot of content needs to be produced at a much higher cost because of safety measures due to the current situation. And that is causing the cost of these things to go up. So in the short term, earnings are going to go down for the Walt Disney Company. But there is also the fact that they're going to be producing less content, which means that for their direct-to-consumer channels, producing less content could have a negative effect. Now, safely, this is also the same thing for most of their consumers, so there's not going to be a disparity about lesser content. That's just going to be an issue for the industry as a general. Now, they did mitigate a lot of this risk with their CFO adding a huge amount of cash towards the balance sheet, meaning that they have a long possibility to sustain at the current level. But also, as I mentioned before, they're actually making a profit even in this current situation, which is quite remarkable for a company to be able to achieve that. Overall, I think this company has a very good possibility to get through the current situation. They have enough cash in the balance sheet to be able to survive this, and also because they're currently profitable, I think they're very well positioned to grow. So overall, this risk that they have, I would give them a rating of a B, which is very good and something that is something you can consider. Now, last but not least, we have their management, which for me is very important before I start investing into stocks. Because a good management can make a stock or break a stock. And that's why I also added in this video so that we can analyze if the management is able to use the current situation and maximize the results out of it. Their CEO, Bob Chapek, came into the company in 1993 and basically headed their home entertainment services and grew that out towards a very big part of the revenues of Disney. Next, Bob Chapek went into the consumer products section, and basically what he did here is he integrated the Star Wars line into the consumer products section and made it one of the biggest sections worldwide. Next, he became the chairman of Parks and Resorts. And what he did, he basically helped build the 6th resort, the Shanghai resort. And from there managed to make it a very good success overall. The success was so good that he even made it possible to get 11 million visitors in the first year towards the park. Now overall, Bob Chapek eats, breathes and sleeps Disney. He's been in the company for so long, he knows every single aspect of the business. And his position right now with Disney Plus and their direct-to-consumer side is, from me, spot on the most important thing for them to focus on. So for overall, on their management side, if I look at all of their team members combined, I definitely rate their management as an A. Very, very well qualified to get through the current situation, grow the company, and make it excel in this direct-to-consumer side. Now that we discussed all of the points, let's recap all of them one more time. So let's go over it. I gave the current valuation, I gave them a D. Basically, because of their earnings are going down, because of the situation, their current valuation is definitely not on par what I normally invest into for a company based on value. Second, we have their growth. Their growth potential is excellent, really well with their direct-to-consumer side. I think it's going to be a major impact towards the entire economy of the subscription models that are out there right now. So definitely an A rating for their growth. Third, we got their risk. They do have some risks right now because of the closures, and that's basically going to be lesser earnings. But it does not have a risk of going down or going bankrupt. So I give their rating right now a B. And lastly, their management. Their management consists of a great team of professionals which will basically be able to grow this company very well in the current situation. And I think with their pivot, they're definitely putting themselves in a good position. So an A rating overall for their management. Now, what is my rating for this stock overall? I'm rating this stock as a B. So it definitely is not one of the best stocks out there, but it's not a bad stock to have. Because of their growth potential, I think they have a very good forecast for the long term. But if you're buying this stock, I definitely do not recommend buying this for the short term. Short term, their earnings are going to go down. And just a disclaimer, I do own stocks in Disney, and I'm always going to refer that if I have a stock or not when I do an analysis. So I am committed towards this company for the long term. I really think their direct-to-consumer side is going to have a very high potential of growth. Now, guys, if you like this content, subscribe to this channel and hit that like button. And if you want to hear anything else from me or do any other stock analysis, leave a comment below. Otherwise, there are going to be a couple of videos right here that you can take a look at and go from there.